Hey everyone, let's dive right into today's explainer and decode exactly how today's macroeconomic trends are actually impacting your wallet, your next real estate move, and just your daily life in general. It's June 15th, 2026, and the data we're looking at today tells a pretty fascinating story of an economy that is kind of being pulled in a few different directions all at once.
Here's our roadmap for today. We're going to cover inflation and energy, the Fed's balancing act, housing market momentum, the shifting job market, a sweet family hack featuring some amazing cinnamon fudge, and finally, what to watch for in the week ahead.
All right, Section 1, Inflation and Energy Costs.
So let's kick things off with the big macro picture. Consumer prices remained elevated in May, rising 0.5% for the month and hitting 4.2% from a year ago. Now, a huge piece of this upward pressure is actually driven by higher gas and fuel costs, which are directly linked to the ongoing tensions in the Middle East.
So here's the crucial translation for you. Headline inflation looks, well, undeniably hot right now because of that gas data. But when we look at core inflation, which strips out those super volatile food and energy sectors, the underlying trend is actually much more moderate. Core inflation only increased 0.2% in May, putting it at an annual rate of 2.9%. That is a very different story than the flashy headline number you might be seeing on the news.
And we're not just seeing this at the consumer level at the gas pump. These exact same energy-driven price pressures are very evident at the wholesale level too. The Producer Price Index, or PPI, rose a full 1.1% for the month and is up 6.5% year over year, again, largely due to energy. If you look at core wholesale, it increased a much more manageable 0.4% in May and 4.9% annually.
Moving on to Section 2, the Fed's Balancing Act.
Okay, so let's look at how national policy responds to these numbers. With inflation running hot on the surface thanks to energy, but actually remaining moderate at its core, what is the bottom line for the Federal Reserve? I mean, how are they supposed to act on mixed signals like this?
It literally all boils down to what we call the dual mandate. The Federal Reserve is essentially tasked with balancing two often totally competing goals. On one hand, controlling inflation, and on the other, supporting a healthy job market. They are walking a very, very delicate tightrope right now. You see, rising inflation makes interest rate cuts much less likely. But if we see signs of economic weakness, that totally increases the pressure to lower those rates to stimulate the economy. It's a tough spot, for sure.
Because they're walking this tightrope, the Fed has held its benchmark Fed funds rate completely steady so far in 2026. This comes after 3 rate cuts late last year. And remember, while the Fed doesn't directly set mortgage rates, its policy decisions play a massive, massive role in shaping the borrowing costs you and I experience across the entire economy.
Which brings us to Section 3, Housing Market Momentum.
So, how is this whole balancing act actually hitting Main Street real estate? Well, despite the broader economic pressures and those steady rates, existing home sales actually increased for the second straight month in May. This really highlights a surprising resilience in the housing sector that honestly might shock some folks, given the inflation data we literally just reviewed. Sales actually reached a seasonally adjusted annual rate of 4.17 million homes. That represents a 3.2% rise from April, making it the absolute strongest pace of sales we've seen since last December.
Meanwhile, the median home price hit $429,000. But here's the silver lining. Housing inventory did improve slightly, climbing 3.3% month over month to 1.55 million homes. So, yeah, while it is definitely still a highly competitive market out there, the recent increase in both inventory and sales tells us that more buyers are finally finding some solid opportunities.
And even though the market is still historically undersupplied, the experts are pointing to a very specific reason for this fresh momentum. Lawrence Yun, the chief economist at the National Association of Realtors, totally attributes it to improving affordability. As he notes, mortgage rates, despite holding steady recently, actually remain lower than they were a year ago and are sitting pretty close to their long-term historical average.
All right, let's shift gears. Section 4, the shifting job market.
Let's look at the other half of the Fed's dual mandate, jobs. When we look at new unemployment claims, they increased for a third consecutive week, reaching roughly 229,000. Now, on the surface, that is a relatively modest level by historical standards. But as with all data, we really got to take a much closer look to truly understand what's going on behind the scenes.
Because that modest number, it might actually be masking a massive behavioral shift in the workforce. Some workers who lose their jobs are now just pivoting directly to freelance, contract, or gig work rather than going through the whole clunky process of filing for unemployment benefits.
And because of this, the underlying labor market challenges might not be fully reflected in these initial claims numbers at all.
And this right here reveals the hidden reality of the job market. Continuing unemployment claims are elevated at 1.795 million. What this tells us is that those who actually are unemployed and filing are taking a significantly longer time to find their next opportunity. For them, the hiring process has noticeably slowed down.
Okay, time for a quick break. Section 5. Family Hack. Sweet Fudge Palate Cleanser. After all that heavy macroeconomic data, we definitely need a palate cleanser. And tomorrow, June 16th, happens to be National Fudge Day. So this cinnamon chocolate fudge recipe is just perfect. Courtesy of Food Network, it yields 4 to 6 servings of just rich, chocolatey goodness with practically zero effort. You just butter an 8x8 pan, lay down a cinnamon strip and a teaspoon of vanilla. Then you stir 2 cups of bittersweet chocolate chips and 3 tablespoons of butter over barely simmering water until it's perfectly smooth and glossy. It only takes about 6 to 8 minutes. Pour it in, add a sprinkle of flaky salt, chill it for 2 hours, and cut it into squares. It is literally that easy, and I totally recommend giving it a try.
Okay, palate cleansed. Section 6. The week ahead.
While that fudge is chilling in the fridge, let's prep for a seriously packed schedule of economic data dropping this week. On Monday, we start by tracking home builder confidence. Tuesday brings us new construction data and kicks off the highly anticipated Federal Reserve meeting. Wednesday is the big day. We get the Fed policy announcement alongside pending home sales and the latest retail sales figures. And then on Thursday, we wrap up the week with the update on those crucial jobless claims we were just talking about.
And that leaves us with the absolute biggest question of the week. Investors and everyday consumers alike are going to be watching super closely. How is the brand new Fed Chair, Kevin Warsh, going to navigate his very first policy announcement? How on earth will he balance this incredibly delicate economic tightrope of sticky energy inflation on one side and shifting prolonged unemployment claims on the other in his big debut? It's going to be a wild week, and we'll be right here to break it all down for you in our next explainer. See you then.